So chapter 4 is mutual funds and investment companies. We've talked about different types of securities and different types of assets, stocks and bonds and money market securities and how they work. We've talked about the markets in which they trade, and now we're going to talk about very common ways in which these are combined into these investment companies, mutual funds being the most common. Okay, so here's the outline for the chapter. We'll talk about the functions of an investment company. We'll talk about this calculation of net asset value. We'll talk about the assets that are in investment companies, the liabilities, and then the equity, how they're owned. And different types of investment companies have different ways in which they're owned, and the profits are paid to the investors. We'll talk about the different types of investment companies. First thing we'll talk about are limited partnership investment vehicles, and these are investment vehicles in which the ownership stake is a limited partnership stake. And there are venture capital and angel funds, private equity funds, mezzanine funds, hedge funds, and we'll talk a little bit about some hedge fund strategies. The next big category are mutual funds, and we'll talk about the different types of mutual funds, how we categorize them. And the first way we categorize them is how people buy and sell the fund. Do they buy it directly from the fund, or do they buy it from another market participant? We'll talk about the portfolio decisions that mutual funds make. We'll talk about the types of assets that they hold, and we'll talk about the different ways in which mutual funds charge fees. Next, we'll talk about exchange-traded products, ETFs, ETNs, and ETCs. And then finally, we'll come up with a little mathematical way to compare investment choices. And then we'll talk about what the definition of a 40 Act fund is, and then these things called liquid alternatives. Okay, so investment companies. These are financial intermediaries that collect funds from individuals and then buy a wide range of assets, or maybe take other positions, both long and short. And the functions they provide are, well, record keeping and diversification and divisibility. So sometimes I can have a small amount of money and buy lots of different stuff, or I might have something that's really, really expensive, and now I can divide that amongst many investors. They may provide management or asset allocation advice, maybe, and they often provide economies of scale in that they are large funds and they can lower transaction costs. Okay, let's talk about the net asset value. The net asset value is equal to the equity in a fund divided by, I'll put parentheses around this, even though we don't really need it, but maybe it looks better, the number of shares issued by the fund. Now the equity is going to be the market value of the assets minus any liabilities, and again, we're going to divide that by the number of shares. And so this is the net asset value, so it's assets minus liabilities, and even though it doesn't say it, it's per share. And so here, number of shares is the number of shares issued by the fund, not the number of shares of stock held by the fund. So we want to be very careful. This is an equity number of shares, not the number of stock shares held.